Good afternoon, everybody. Good evening, whoever is in Israel. First of all, I'm happy to be back with all of you to do some Zoom meeting. It's been a while. As usual, I'm gonna mute everybody just so we're not gonna have any background noise. But whoever wants to ask or something, just feel free to get yourself out of mute and ask the question. It's a conversation, it's not a lecture. It's a conversation, so feel free to stop. And maybe we answer, maybe Mendy answer, maybe we're gonna say, okay, we'll keep it for the end. But again, it's a conversation, so feel free. In general, we prefer to let Mendy talk, and then at the end, we'll answer all the questions. I'm gonna stop Mendy once in a while to see if everything clear, especially when we change subjects. Other than that, I'm gonna give the floor to Mendy. Mendy is my insurance broker, one of my insurance broker. He is the one that helped us with the insurance in the deal in Texas, Ophir, for you. And I can tell you, he gave me excellent quote, saved me a lot of money. So if you save me money, I'm giving you guys the opportunity to save some more money. So feel free to reach out to him. I'm gonna send when we're gonna end up this meeting. I'm gonna upload it to the YouTube as usual, and then I'm gonna send a link to everybody with the contact information for Mendy. So whoever wants to reach out to him, feel free to reach out, talk to him, ask, and hopefully also do business together. Mendy, floor is yours.
Thank you, Tal. Thank you. And it is a pleasure always working with you. Thank you, everyone, for taking the time. I'm going to briefly go through a presentation, but yes, it's not a lecture. At any point, if you feel there's something that you want to ask, you can write it down and ask at the end, or you can jump in and we'll pause and we'll discuss it. Good evening, everyone out there in Israel. That's awesome. So my favorite topic, and I think everyone's favorite topic, insurance. So we're going to jump right in. I will take about 90 seconds. If we're going to spend the next little while talking, let's get to know me a little bit. So here, this is me, and this is my family. We got a couple of weeks ago, we made a bar mitzvah in Mexico, my oldest boy. So we all got out there for the weekend, all the family and friends. A couple of things I like to do. I like to play hockey. I like snowboarding. This weekend, I'll actually be in Vegas for the Formula One race. I love it, follow it closely. So excited about that. On my spare time, I actually made this beautiful vodka just as a hobby, as a fun little thing. So if any of you are ever in town and you'd like a quick cheer, I'd be happy to give you a bottle. I love good meat. I love good sushi. I love a good cigar with some whiskey. But most of all, I love insurance. And we're going to spend the next little time talking about insurance. And I'm going to go through some different products we sell. Obviously, when it comes to insurance, there's so much. There's a lot to discuss. There are certain programs that might benefit some of you. There are certain programs that might not be applicable to you, but we can set up a separate one-on-one conversation and we can discuss all the anything that you have questions about. So we're going to be discussing a couple of topics. First of all, why Oak Tree? There are a lot of insurance agencies around. Why specifically Oak Tree? A little educational, a couple of things you might see on different policies that you're always wondering what they're about. And obviously you can ask any of your own questions, but I'll be happy to discuss a couple of them that I just noticed many people just don't understand on their policies. There are a couple of programs that master policy specifically I want to spend a little bit of time on for 1 to 4 units, and then obviously for the larger ones, recent success stories and some of the carriers we work with. Okay, so first of all, why Oak Tree? There are many agencies. We all have access to similar markets. Obviously, the big one is, we want to make sure you're with a brokerage, an agency that has access to all the markets so they can shop it around with everyone. But service, it all comes down to service. We pride ourselves in our service personally, and obviously I look forward to working together, or if anyone were to give me an opportunity, you'll notice fast. We respond to emails, we respond to phone calls. The next thing is we're licensed in 47 states, and that's a big deal. For real estate investors, that if you're working on properties in multiple states, you don't need to use multiple brokers. We're licensed in 47 states. We write all different products, all different lines, so that can be helpful. We specialize in real estate. I understand most of you are in the real estate industry. That is our niche. We focus on real estate. A large percentage of our book is in real estate, and we write professional liability, we write all lines of property and casualty, but our niche is real estate. So that would be our focus. We actually have a hedge fund in Israel that we write for. They purchase over $150 million of properties in the US, primarily in a couple of states, and we write for them. So we deal a lot with investors in Israel, and yeah, the next is the support through the whole process. We have a large team here. We have claim people that can help you through the claims process from beginning. We have the that deal with the banks, obviously any endorsements. I'll be your primary point of contact. Any questions about the policy, but we do have a large team that can help you through the process. We write with all markets. We have a large book in real estate. So when it comes to real estate, we've been around for a long time. We have access to everyone. A lot of the new brokerages, they may not have appointments with all the carriers right now. Carriers are not giving appointments to everyone. We write with everyone. So that really helps us tremendously. And then a big one about our agency, and you'll notice, is we shop it at renewals. There's a process we have 90 days prior to every renewal on every policy. We will shop it out with all the carriers, and they'll give us all their options. And then 30 days beforehand or 15 days beforehand, depending on the policy, you'll have all your quotes in front of you, and that helps because we have leverage. When you might notice that if you have a policy and you've been with the same carrier for 10 years, the premium's not going down. They're going up and up and up every year. So it is important to shop it out at renewals, and that's what we focus on. Next, we're going to do a little bit of education. So there's a couple of things you'll notice on the policy. First of all, your typical policy is called a commercial package policy. Now, there's two things. There's property coverage and there's liability coverage. Now, some of these, most of you understand already. I'm going to go through it briefly. But when it comes to property coverage, how much property coverage do we get? That's a big question I'll always ask. Hey, I bought this property for $10 million, but the carrier wants $50 million. I don't need $50 million of coverage. It only cost me $10 million. That's not exactly how it works. When you're getting insurance, you're not getting insurance on how much the property is worth. You're getting how much it would cost to rebuild the property. So there are three people that want to certain requirements for coverages. There's the bank. Obviously, the bank wants to be protected. When you're buying a property, you're putting in 20% or however much you're putting into that property. The bank owns a large percentage of the property. They want to make sure if there's a fire and there's a total loss, you're not going to pick up and walk away. They want to make sure that they can be indemnified and you'll rebuild the property. So that's why they want to make sure what's called replacement cost. The policy is written with replacement cost. We'll get to that in a moment. Or they'll want their loan amount. But between those two options, and that's how we'll determine that. There is how much the bank wants. The next thing there is between you and I. We're going to have a conversation. We're going to say, hey, this property, the bank wants us to get, $1 million of coverage, but between you and I, it might cost $1.5 million to rebuild this property. So we might want to get $1.5 million in coverage. And then there's the insurance carrier. The insurance carrier wants to make sure that there's sufficient coverage. They have what's called a replacement cost estimator on how much they believe will cost to rebuild the property, and they want to meet their numbers. So between those three, we'll have a conversation. Obviously, once I get to know my clients and I know how they work, I'll copy paste on all future quotes that we work on. The next thing is liability coverage. Liability coverage is third party. If a third party lawsuit, someone slips and falls on the sidewalk, that's the most typical one. Unfortunately, we see that in New York a lot, but we see it all over. People feel that a quick slip and fall, and that's their ticket out. That's a big loss. So every policy is going to have the property side and the liability side. Obviously, the lenders, they want to make sure their building can be protected, but we want to make sure that if someone gets hurt and there's a lawsuit, that you'll be protected. Something you'll see on policy that's very important, and lenders will always request it, is they want this written as replacement cost. What does replacement cost mean? There's two ways to write a policy. There's something called replacement cost, and there's something called actual cash value. If you buy a couch for $10,000 and it's in your home, and suddenly there's a fire, 10 years later, there's a fire, and now the insurance carrier comes to you and says, you bought that couch for $10,000 10 years ago, but now it's only worth $1,000. So we are going to give you $1,000. That's called actual cash value. Replacement cost means we are going to replace the couch for how much it is worth, and that is $10,000. So the lenders want to make sure it's written with replacement costs to make sure that they are fully indemnified and they can fully rebuild the building. The next thing you'll notice, a lot of times lenders will tell you, we don't want co-insurance. What does co-insurance mean? A lot of people, More often than not, people don't understand what co-insurance is. When you're buying coverage, so we discussed before on how much coverage you want. When we decide on a number, let's say you have a property in Ohio, and in different states it could cost a different amount to rebuild. But let's say you have a property in Ohio and it costs $150 to rebuild. And you say, hey, I bought this property for $1 million. I know it will cost X amount to rebuild, but I paid so little, I only want $1 million of coverage. However, if it will cost $1.5 million to rebuild and you only have $1 million of coverage and the policy has co-insurance, you will be penalized. If there's 80% co-insurance, what that means is they want you to be insured 80% to be able enough to be able to rebuild the property. That means if the property were to cost $1 million to rebuild, they want you to have a minimum of $800,000 of coverage. And if you have $500,000 of coverage, you will be penalized. And that's why the lenders don't want that. And we also want to make sure that we don't have that. And obviously deductible, that's how much you're responsible for. So a lot of people may not know this, but you can increase that deductible significantly and get large savings, especially on large portfolios. Very often why are we getting insurance? Very often we're getting it to just keep the bank happy. The bank needs it. We're required to get it. We don't plan on ever making a claim. So you can increase that deductible drastically and you can get significant savings out there. Real estate investors master policy 1 to 4. So there are different programs. Currently, we have quite a few carriers that are writing the 1 to 4 unit master policies. And what that is we have a lot of real estate investors. They come in, they buy these properties that are between 1 and 4 units, and they fix it, they flip it, they sell it, or they hold it, they rent it out long term. So, you can get a standalone policy or you can roll them into a master policy. I'm going to list some of the benefits here that we can get with the master policy. And again, feel free, if anyone afterwards, take notes, ask questions on this. We've had a lot of success with these master policies. The reasons are, we'll start with the first one, the leverage. Obviously, when you're shopping with one property, you're going to get a certain price. When you come to someone and say, hey, I have 100 locations, that gives us leverage. That gives us an opportunity to negotiate with the carrier and to bring down the rate. The next one's the no inspections. The master policies, well, we write with many of the carriers, and a lot of them don't require inspections. These are specifically for real estate investors. And we all know these days, every time there's an inspection, they always come back with something, whether it's a broken sidewalk you have to fix or completely replace your roof, especially if you're buying a property and you're going to renovate it and you're going to sell it afterwards. You're not interested in within 30 days having to comply with all of their loss control recommendations. So it's a big deal. They don't require inspections. The next thing is the locked-in rate. At the beginning of the term, we will negotiate with the carrier, and in that state, we will get you a locked-in property rate. Every property you add to this master policy, you're paying the same exact rate. When you're buying a new property, you don't even have to call me. You'll know instantly how much you're paying for that policy because it's based on how much coverage you're getting, which is based on the square footage of the property. The next thing is one policy for the entire process. Now, when you buy a property, the first thing you need to get is a vacant property policy. The next thing you need to get is a renovation. Once you start the renovation, you need to cancel that one. You need to get a renovations policy. Once the renovations are complete, you need to cancel that policy and you need to get an occupied policy. The master policy are designed for vacant, then renovate, and then occupy. So they will allow one policy through the whole process. As you see on the next one, there's no vacancy exclusion, there's no renovation exclusion. Now you might be buying a property, you'll buy it as occupied, and you may not have an issue. Well, there is no issue until there's an issue. If there is a claim if there's a claim on a property that's vacant and you wrote it as occupied, that is the number one reason they will deny coverage. Or if there's an occupied policy and they show up and they see there's a claim and there was ongoing renovations, that is a big reason and an easy reason for them to decline coverage. The next thing is reporting form with binding authority. What does that mean? That means when you have a master policy, the term stays the same, January 1st to January 1st, or whenever we started, November 17th this year till next year. At any point in the policy, you add a property, The way it works is you send me that address. We will automatically send you the binder and the invoice. There is no needing approval. There's no process to get approval. And then, in order to be able to send it over to the banks, we will automatically send you the binder and the invoice. Now, at the end of the month, we will go through all the properties that we sent over. You'll let us know which ones you purchased. And those are the ones we'll add to the policy because we have binding authority with the master policies that will allow us to give you the binder right away. You can check it off with the bank. If the property falls through, we disregard it. If you purchase it, whenever you do, that's when it gets added onto the policy. The next thing is flexible coverages. When you buy a property, very often you go to the carrier and the carrier says, hey, there's 1,000 square feet or 100,000 square feet. We are going to need $300,000 of coverage or $3 million of coverage. When we have a master policy, we can negotiate and get locked in approval on $125 a square foot. Now, there are times where we'll want more than that, but it allows us the opportunity on certain properties to please the bank. They'll be written with replacement costs and to allow us to get a lower premium with lower coverages. It's designed for real estate investors and banks. It meets all the requirements. It meets the replacement cost. There's no co-insurance. The deductibles are flexible. The coverages are flexible. It meets all the requirements for the banks. And the last thing are claims. When it comes to claims, there's a couple things. Number one, if you have a claim on a property, you'll notice it's very hard to get insurance on that property or the premium will skyrocket. When you have a master policy and there's a claim on one property, it can drown out with all the other properties. We have leverage. If you have 100 locations and 3 of them have claims, the other 97 will help us bring the premium down on those 3. And then the other thing is if there's a claim, you're not dealing with 100 different carriers. You have one carrier with all of them, the same claims adjuster, the same loss adjuster. It's just an easier process throughout. The master policies for any larger properties, they are similar. There are some things they have, there's some things they don't have. But in addition to that, obviously, whether it's an apartment complex, whether it's a portfolio of apartment buildings, whether it's commercial, residential, we're writing with all of the markets. We have access to everyone. So obviously, we have that. Recent success stories. So there are many times we'll start off with a client, they'll write one apartment building.
Mendy, 1 second.
Yes.
Guys, any question, anybody regarding the master policies and the idea behind them? We'll take a break here for a second to see if there is any question. Anybody?
Yes, if anyone has questions on any of these points, I'll be happy to answer them. If you just in general about, please jump in, go ahead, or we'll move on to the next thing.
Yeah, quick question. Is there any premium with a master policy, or is it actually a discount overall?
Every single risk is different. Generally, we're going to get substantial savings, but every risk is different. There are times when, I'll have a master policy for someone, they'll send me a specific risk and I'll say, hey, we may want to leave this one off of the master policy. Look, the master policy, forget the price. Now, the price will always be more competitive because we have and good question, because we have we have leverage, but the benefits of the no inspection of there are a lot of other benefits that are not just regarding the price, but the price will generally, we're never going to move someone off if it's going to cost them more money. There are times where people are just fed up with the inspections or, the exclusions or just their banks don't allow it. So we'll put them onto one of these master policies. But to answer your question, yes, the savings are significant. But obviously the benefits are there as well.
Got it.
Any other questions on the master policy? Thank you, Chris.
Any other questions? Let's continue.
Perfect. Okay. The next thing, recent success stories. So, and I'm not just bringing this up to discuss recent success stories, but it's also to understand that, what happens, there are times where someone reaches out to us for an apartment building, over the years, they add, a second one, a third one, fourth. And then eventually it gets to the point where, hey, this can, we can move this over to a master policy. We'll be eligible and we can get significant savings. So converted a portfolio of apartment buildings onto single master policy and saved the client a little bit over $800,000. So yes, the savings can be absolutely significant. Now, again, there are times when someone will tell me, hey, I don't need this much coverage on all my buildings, but the carriers are requiring that. So I'll say, one of the options for us to be able to be a little more flexible on the coverages is convert it to master policy. We may go down on the coverages, but we'll get significant savings. I just had a condominium in the city. They had a massive claim. They were with their broker. They had the renewal. We shopped it out. We saved them over $170,000 on one property. And this is very so. We have access to many markets. Next, what carriers we work with? Here's listing a few, but we write with everyone, whether it's Travelers, Nationwide, Liberty. We work with wholesalers. We work with all the direct markets. Yeah, that's that. That's about the end of it. So over here, we'll open it up if anyone has questions to anything that we brought up, or just an open conversation discussion. I know insurance can be, it's frustrating. A lot of us feel like we're paying for something that we may never use, and the reality is we hope to never use it. And more often than not, we're getting insurance because we have to. As much as we want it because it helps us sleep at night after making that big purchase. We're more often than not, we're buying insurance because we want to close on the property and the lender has their requirements. And yeah, if you had any frustration with insurance in the past and you're curious, please jump in and ask a question, or if anybody wants to bring up any topic, I'm here to answer it. This is my favorite topic. I love doing this. And if anybody wants to schedule a one-to-one with any questions, please reach out to me. My contact information, we'll make sure to put it out there. Reach out to me, set up a phone call, set up a one-on-one, and we'll discuss.
Mendy, we just started. The day is young.
Yes. No. I know. I just want to make sure that if anybody's not hanging around or anything, they're all aware. Yes.
I want to ask you to specify a little bit about the different type, because for many of us, when we say, we are taking insurance here and we need a property insurance, all they look at in their mind is, something happened to the property, now I have an insurance. But the fact is, and I can tell you that out of my experience, my investor was surprised that, for example, one of my deal in Houston, we actually needed 5 different insurances, which were liability, property, flood, rain and hail. And so specify a little bit about the different type of, when you talk about insurance, it's a very general word to many different type of insurances. What the main ones,
absolutely,
the main one that you have, and which area a little bit. That's my question number 1. Question number 2 is, again, because I'm now we're doing Houston, a little bit about Texas, and a little bit about, because I know people are interested, Ronnie is not here, what's going on right now in Florida and California in regarding to our abilities to insure properties, because I know that's an issue for many investors, many Israeli investors in specific. So I'll be interested. So let's start with 1.
Yes.
Different type of insurances. When do we need to consider each one of them? Rain and hail, flood, all this type of different liability, rent, all of this stuff. What do we have and where do we need to consider it?
Perfect. Great. Good question. Okay, so here, let's start off with what you first mentioned, Texas. So you'll notice if you write a policy, let's just say in New York, in many areas in New York, when you write a policy, it will include everything. It will include property insurance, and we'll get through each one, but it will include liability insurance. It will include wind and hail. It will include flood, everything you need in that policy. And more often than not, when you're buying commercial properties, the lenders will require you to have all the insurances in place. Now, you brought up Texas. And when it comes to buying a property in Texas, more often than not, when we get a quote, you'll see in bold letters, wind and hail excluded. Why is that? Because Texas, obviously, they have, every state has different exposures, and different carriers don't want to put themselves at risk for the wind and hail. So they'll say, hey, we're willing to offer a quote that will cover fire, that will cover, whether there's an earthquake or there's different, but we don't want to touch the wind aspect, or
All
we
the
don't
stuff
want to
that's
touch the
not,
flood aspect
they're willing to
that
offer
they'll never have to
the
pay out
stuff
to.
that never gonna
Exactly.
happen.
The stuff that are never going to happen. Exactly. And then you want to get whether it's fire in California. We'll get to each one separately, but you want to get wind in Florida, or you want to get a flood in a flood zone. You'll have to get a separate policy for that. So yes, they're all separate policies. And to back up a moment, there are three ways to write a policy. There's something called basic form, there's something called broad form, and there's something called special form. And what that means, and I have to figure out how to add some attachments here so you can see them in writing. But basic form means we are willing to cover you for these 10 listed perils. I mean, if any of these 10 causes of damage, it's in the industry, it all comes down to what is the cause of damage. So any of these 10 items happen, you're covered. If a policy is written under broad form, and I believe it's 13 different, causes of damage. We want to write policies that are listed under special form. What special form means is you're covered under every circumstance unless it's specifically excluded on the policy. Now, what are common exclusions? Number one is flood, and number two is earthquake. Those are two items that are commonly excluded under all of these policies. Now, there are packages that will include it, but generally they're excluded, and you'll want to get a separate policy. Now, if you're writing a property in California, we all know the fire, it's obviously that's the major issue there. And last year we saw State Farm a couple of months before the fires, they completely pulled out of California. Now, why did they pull out of California? Everyone could have their reasoning, but the reality is they're an admitted market. And when you're an admitted carrier, you're required by the state to follow certain guidelines. You can only charge certain prices. You can only offer certain coverages. And they said, hey, if you're going to require us to do A, B, and C, but we can't charge enough that we feel we'll be able to protect ourselves, we're going to pull out. They pulled out, and a few months later, all the fires, they saved a lot of money. I'm sure someone at the top of State Farm received a nice raise, and that's why they pulled out. That's why a lot of carriers, you'll also notice, will go from admitted to non-admitted, because when you're not admitted, you have a lot more options to be more flexible with coverages. You could charge more money, but at least it gives you an opportunity to write in those areas. So if you're writing a package policy in California, very often you'll have to, get fire separate. Now, a lot of the states, for example, California, if they're going to require you to have insurance, they're going to be required to also offer a product. And that's why you'll see a lot of people get a package policy with an admitted carrier, and they'll get the fire with the state plan, or they'll get, in Florida, they'll use the state citizens. That's for the homeowners market, they'll use this state run. But yeah, regarding different coverages, let's back up. If you're in Texas, wind and hail is an issue, flood is an issue. So the first thing we'll want to do is we'll want to shop it out with the carriers that will offer us packages. We'll get declined by many, but we still have to go through the process. We'll shop it out with everyone. The next thing is we'll take the best option. They're excluding wind and hail. Okay, who are the markets that are willing to write monoline wind and hail, standalone wind and hail? Who's willing to write it? And then we'll get those quotes. If the bank is requiring flood, or if it's in a flood zone, we'll get those as well. Now, really quickly, what are the difference between, sometimes people can get confused here. Flood, outside water coming in, very different than, let's say, water backup, where the water, the sewage pipes back into the house, or let's say, a busted pipe. Different causes of damage are covered by different coverages in the policy. You obviously want to understand your policy, understand which coverages, and go through that. And then so Texas, and then just to jump back into Florida and California. Florida, obviously, the hurricanes, the winds, that's the major issue now. We are seeing, I'd say, the market at this point is probably it's softening up a bit. We are seeing some carriers join the market. The way it works is whenever you have these state-run carriers, they're allowed to offload your policy to any private market that's willing to offer a quote within 20%. You'll notice, let's say, Citizens, every year at the renewal, they'll say, hey, here are all these other options you can take. If any of those options are within 20%, boom, you're required to take that policy. But with Florida, more often than not, I'll have whether, let's just take a home, for example, I'll write a policy for, 10 to 15,000 for the home, excluding wind. And then the wind alone will cost $50,000. That's not uncommon. Obviously for the nicer homes, obviously for smaller homes, at a lower premium, but yeah. Okay, I hope those that answered that. And yeah, jump on to the next.
I want to say something about that. When we got the quote for the deal now in Houston, without rain and hail, without wind and hail, it was about $12,000. To add just the wind coverage cost us another 12,000. So just for the wind, the premium double itself, just for that
Yeah,
specific
that's
wind
not
coverage.
uncommon. That is not uncommon. It all comes down to, they have their algorithms. What is the most likely cause of damage that's going to happen to this property? And we discussed it on this one.
Yeah.
If it's a residential building or an office building, even though there's the same likelihood of potentially having a windstorm there, you have certain programs that are designed for for rental properties that are residential, and then you have certain programs that are want to write office buildings. Yeah, so every risk is different, but yeah, absolutely.
Now I'm going to ask you a tricky question because I see people are feeling, let me talk. So I'll ask you a tricky question. As a insurance broker, insurance guy, whatever you want to, which state, and again, I know that we discussed a little bit the hard cases, which is California, Texas, that. But from your end, 47 states, if you had to choose 5 states that are red flag for insurance reasons,
uh,
which state is going to
um,
be the red flag for insurance reasons? So don't any other for
I
you
will.
like, oh, this is going to be trouble.
So I'll answer that like this. First of all, when good question. So when someone reaches out to me, and I'll get requests constantly, and someone reaches out to me, hey, I'm buying a property here, blah 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 blah, and at the bottom I'll see the address, and it's a Florida address. So yeah, automatically it's okay. Here we go. We got our work cut out. I mean, if you reach out to me for a New York property or New Jersey, Pennsylvania, anywhere around, it's just they're very easy. There's a ton of markets. The markets have drastically softened. Everybody is fighting for business now. The way it works is you'll have a hard market. There are claims. Carriers will leave. The other carriers, whoever is here, it starts getting expensive. Suddenly, the outside carriers that are not writing there, at a certain point, the prices get so high where they're like, hey, at this point, we can make money. We can be profitable. So they'll jump back in. And it happens very fast where all the carriers start jumping, and that will soften up the market. Right now, I'm getting renewal quotes. Remember, we always assume insurance is going up and up. I'm getting renewal quotes without even shopping it out, without beginning that process. The carrier comes to me, here's your renewal quote, 15% cheaper. I haven't seen this in a very long time. But back to your question, what 5 states? So off the bat, I'll tell you, when someone reaches out to me, whether it's California, Florida, Texas, certain parts of Texas are easy, certain parts of Texas are difficult. Connecticut has become just for different reasons. I'd say those 4. There isn't a fifth one that just jumps out to me that's extremely difficult. But those 4 are the ones that I'd say I'll have my work cut out. But again, it's not at the end of the day, we have the markets, so it's about shopping it out. The only difference is it's going to be more expensive. The coverages are similar. You might need more policies to cover the entire risk. You might need to shop it out a little, to get the right carrier. But it's I wouldn't say there's anything like a red flag because look, there are buildings all over the country and they're all insured. They all have mortgages. They're all required to be insured. So there are carriers that are writing. So wouldn't necessarily say they're a red flag, but when someone reaches out to me for a Florida, California, some parts of Texas and Connecticut, certain areas, I know I'll have my work cut out a bit
What is it with
to find.
Connecticut? Connecticut never. What is it with
Right.
Connecticut?
I mean, we write a lot in Connecticut. There's a lot of claims in Connecticut. There's it's just right now the markets are just not as competitive in Connecticut, and it changes. Again, it just it constantly changes. But yeah,
Um, as let's say I'm coming as a real estate investor. I'm coming to shop for new insurance. I'm buying a property. What items would you recommend for me as an investor? And I'm going to talk mainly about 1 to 4 families because I think most of everybody is here is more in like the 1 to 4. I'm more on commercial side, but I guess most of them. So let's focus on that. But again, if you want, you can apply this question to commercial properties. As a homeowner or a buyer, a potential buyer for a new property, is any things or items that I need to pay attention in order that in the future insuring this property will be easier for me to do and cheaper, obviously. So if there is something like, okay, this is something that it's worth paying attention to it. What is the condition of the, whatever it is? What are the big items that you're like, oh, this is going to affect it? I don't think that a leaking
Right.
faucet is a big deal, but this is going to be 3 big items that, oh, this is what they're going to watch for when you're
Good
shopping for
question.
a new
So
insurance.
yes, a good question. So there's two things here. Here we're referring to real estate investors, and it's very different when it comes to inspections but when you're buying a home, let's say you want to a single family home and you're going to live in that home, right? Right now, we are seeing these inspections, it's become catastrophic. It's almost as if every inspector is required to find one wrong thing. I almost tell people sometimes, maybe leave a little crack in the sidewalk so they don't tell us to replace the entire roof, so they don't, because they have to
Give
find
them something.
something.
Give it to them.
Give them something, because if they don't have, then they'll find the thing in the back of your house that's falling apart. Give them something in the front of the house. But no, the big things we're seeing are the sidewalk, because the slip and falls, and there's a reason for all of them. Carriers, like, you'll see, they'll come out this year, we will renew it with this exclusion. Why? Because they got killed over the past year and they don't want to take that anymore, so they're adding that exclusion. So back up, the 3 things I would say is the sidewalk, the cracks in the sidewalk. Unfortunately, what do we see very often? Someone's walking on the sidewalk, they magically trip and fall. Now they can't work anymore, and suddenly, they won the lottery. They're expecting, there are lawyers, there are signs at every corner. If were hurt, here's a personal injury attorney. Boom, if you slipped and fell, we will sue them. We'll take care of it. So a lot of people are obviously they're seeing that. So the carriers, when they take on a risk, they do their inspection. They want to make sure that sidewalk is in perfect condition, so they're not putting themselves in for a potential lawsuit. The next thing we're seeing now all over are the handrails. Every staircase, whether it's exterior or interior, you need handrails, because they feel that if someone slips on the top step, if there's a handrail, they can grab onto it. If there's no handrail and they go down the steps, there's a lawsuit. And it doesn't matter if it's the steps going into the basement, the steps outside, even if it's just 2 steps right outside. They want to see railings. And the third thing is the roof. Unfortunately, the claims we just see everywhere are roof claims. So when they take on a risk, remember, once they sign off on that risk and the inspection is done, that's it. They're responsible if anything happens. So before they confirm that, they want to look at the roof and they want to say, hey, we're okay with that roof, and we're willing to take on this risk. And unfortunately, more often than not, we'll see not necessarily a roof replacement, but a roof repair or some shingles that need to be replaced. Now, those are, obviously the owner occupied. When you're buying a property, more often than not in the 1 to 4, you're buying a property that's not in great condition. You're going to fix it up and you're going to renovate it. And you're going to renovate it and then you're going to rent it out or you're going to sell it. So when you're buying it, if you're dealing with, these 1 to 4s, they may not be in great shape, which is why a lot of the carriers are not writing them, which is why they get very expensive as standalone policies, which is why the master policy, the no inspection, is a game changer. And I want to back up something. Actually, I didn't do it. I meant to add it into the slideshow, and I did not into the presentation. Is what is the process? When a client that has a large portfolio and they're purchasing properties, what's the process when they buy a new property? And I just want to go through that quickly because that will help with this as well. I have clients that have, they'll have hundreds of locations on a spreadsheet. And then every month they'll buy property. I have one specific one, they buy everything they buy is single family homes. And they buy about, I'd say, between 10 and 15 a month, sometimes more. Sometimes they'll buy large packages of them. And they'll send me an email with an address. And then this specific client, I'll have them include square footage and the address, because the area where they are, it's tough to verify the square footage online. They'll send me that. We'll add that to the spreadsheet. I will automatically send over the binder and the invoice to them. They'll take that and they'll go into contract. Whether they close or not, separate story. They have the binder and the invoice. I'm done with it. At the end of every month, they take that spreadsheet, they highlight all the properties they purchased, and then we add them to the policy. And again, these are real estate investors. So they're buying, this guy specifically is buying properties that are, cheap, that are not in good condition, that if we got a standalone policy, there would be a laundry list of items after the inspection, that they need to forget railings, forget the roof, because they plan on renovating the entire property. So more often than not, to back up to that, more often than not, real estate investors, when they're buying a property, they're not in very good shape. If you're getting standalone policies that have inspections, you're going to get a laundry list of items that need to be done. So there are some standalone policies that don't require inspections, but most of them do. And obviously that's the benefit of the master policy, that we wouldn't have to be worried about that.
I got you. 1 second, Avital, I didn't forget about you. Just specifically before we go to Avital question, which is a little bit different subject, Daniel asked if the sidewalk is not the city responsibility. I can tell you right now, Daniel, it depends on the city. Some cities are responsibility of the property owner that live in front of that sidewalk. Some cities, it's the responsibility of the city. But also when you talk about sidewalk, you need to remember that there is many times the path that goes from the sidewalk to the house with the stairs and all of it. So it's not necessarily just the sidewalk itself, it's also the walkway to the house from the sidewalk that many times it's cracked or whatever it is.
Yeah, so every city, every state, it can be different. Now, there's a difference between the sidewalk and the curb. The curb will be the responsibility of the city, and then the sidewalk, and it also depends what it is. I'll have clients where the city will plant a tree and it will damage the sidewalk. So, they'll file a 311 complaint, and then the city will come down and take a look at it. But again, every city, every state, that will be different. Unfortunately, we deal with a lot of claims. When you write a lot, you'll be dealing with claims, and you'll have people that will slip. If they slip on the curb, that lawsuit will be directed to the city. If it's on the sidewalk and it's responsibility of our insured, that's where our insurance will kick in.
Does the insurance policy cover environmental oil leaks into the ground? I'm going to answer that. The answer is no.
So there are environmental. You can get separate policies to cover everything, anything you want. There is an insurance policy for everything. There's someone willing to take your money to write. When it comes to, because look, when you want to write, we write in the city. A lot of these builders risk when they're trying to build out, and when you write in the city, you have a lot of these landlords that require you to check every box if you want approval, and whether it's pollution or it's there's always someone that will be willing to write something for you.
I will say like this, if it's okay, Mendy. Tal, environmental in the Facebook post, I wrote down that there is only 2 things that can make you lose all your money in real estate. One of them is not be covered in insurance, and the second is environmental. So if you didn't check and you have a pollution in the ground, can wipe the entire investment because it's so expensive. So Mendy is right. There is an insurance that's going to cover it, but it's going to be very, very expensive. The easiest way to do it is to check for environmental. This is, by the way, what I just did in Houston. We did an environmental study over there to see if there is any pollution in there. It's called phase 1, phase 2, phase 3. If you guys want, I can explain about that. That's a different subject. But what you really want is from the beginning, make sure that you don't have any pollution. That is the best insurance for not having. Obviously, it doesn't protect you from future pollution, but at least you know that you don't buy something with pollution. And most standard Insurance specifically doesn't cover environmental because the coverage, the damage can be hundreds of millions of dollars in damage if there is serious pollution in the ground. So it's not
Yes, and every area can be different, Tal. Every city, every state. When I write in Pennsylvania, mine subsidence is a major issue, because back in the day that area. So when we write insurance, we want to make sure we have mine subsidence, in certain areas, sinkhole, sinkhole coverage it can be important in some states. So yeah, but Tal, well said. Yes, well said.
I'm going to go back to Avital 1 second, and then we're going to go back to other question because Avital was the first.
Yes.
Avital.
Thank you. Thank you. Just to explain, I'm a landlord in Rochester, and we sold our houses ourselves. Our houses are in rough neighborhoods.
Avital, there is a, I put you on mute for a second. There is a echo, so we can understand because we hear you twice. So either I can ask the question for you, or I don't know what you do. Yeah, you can unmute yourself, but I stopped you for a second.
Do you still hear it with echo?
A little bit still. Ask. We'll work it out.
If I can make my tenants to do also an insurance, renters insurance, but when they leave the houses, they break almost everything. It's possible for landlords to pay for a tenant to that insurance, and landlord also be written on the insurance so the tenant doesn't do this in another house. Because one of the main problems that we have is that when a tenant is evicted, he brings a lot of things in the house, and it doesn't include the usual insurance or the deductible crazy with high insurance, usual one.
Yes, Avital, good question here. And I think I understand your question. So I'm going to go answer it, and you'll let me know if this answers this. But if you look at most lease agreements require the tenant to get what's called an HO4 policy, that they have to get their own renter's insurance policy. However, unfortunately, we all know that in New York and in many areas, then we're not enforcing it. We're not enforcing the renters to get their own policies. I always recommend, these policies cost about $150 a year, and I cannot recommend enough to require, prior to any tenant moving in, to get their own renter's policy and to list you as an additional insured. There are many benefits to this, but number one, if someone were to get hurt on the property and the renter does not have insurance and you have insurance, who do you think the lawyer is going after? They're only going after you because they know that the renter does not have any insurance to go after. They're not even going to attempt. Now, yes, the reality is everyone will get pulled into the lawsuit, most likely, but if the negligence is of the tenant, they will only go after the landlord if the landlord is the only one that has insurance. So that's number one. I would require. Now, number two, right now I have a client. We have an open claim. The carrier came down. We're middle of, we have to fix 2 of the units in the building, and the units don't want to move out of the apartment because the landlord in New York is not required to pay for their hotel stays. They don't want to move out on their own dime. Now, if they had a renter's insurance policy, there would be loss of use coverage. They'd be able to go stay in the hotel, and you'd be able to require that they leave the property until you rebuild, until you finish the job. So I would definitely recommend. Now, for real estate investors, there are certain programs that will offer like a master tenant policy, that one of the things on there will be tenant liability, that if they cause any damage, unfortunately, more often than not, the damage they cause is that it's not even going to be worth making a claim, which is a shame. But again, if it's significant damage, yes, that tenant liability is there specifically for that. But the reality is we get insurance to make a claim, but if we get insurance to protect ourselves in the event of a claim. But if you do make a claim, it could affect your future premiums. So we do look at it as something that's more for catastrophic situations. And if a tenant is going to break a window or is going to damage, so it may not always be worth making a claim. So, it gets a little tricky on that front if it's worth it or not. We could have a separate conversation on that. But yes, there is something called tenant liability to, if they're going to cause damage to the property, they should, that will cover that. And I would highly recommend that you require every tenant to get to have an HO4 policy.
Is it okay that I pay for it?
For you to pay for it, well,
My
you can't buy.
my tenants will never do that themselves.
Well, if you require from them, I mean, this is very in most of the country. It's you must. In New York, unfortunately, people get away with it in well, quite a few states. But if you tell them, hey, you can't move in until you provide this policy that costs about $100 a year, and you pay about $8 a month, they'll do it. Now, yes, there are ways where you can. Now, you can't buy a policy on their behalf in the sense of as if you're the named insured. But there are for real estate investors, there are master tenant policies where you can buy it on their behalf and you can add that fee into their like monthly charge, and there are ways to do that. Yes.
No, the question, I think, Mendy, maybe I didn't understand you. Maybe I don't know if that. The question is because you said if you submit a claim, it's gonna raise your premium. But the question is, do you have a policy, a tenant policy that cover my damages? Because if the policy is on the name of the tenant, there is no reason that it's gonna raise my premium. It's his premium.
Okay, so you're talking about if the claim is being made against the tenant policy.
Yeah.
Yeah, I mean that's just, again, if I'm understanding the question, yes, that's a standard renter's policy. And yeah, any claim that's made on that one is not going to affect your premium. Now, you're not buying a standard renter's policy on behalf of your tenant. That's the person that's purchasing the policy needs to be the named insured. There are specific master tenant policies that are designed for. I don't write these. They're specifically through some of the portal. Again, I'm not sure what platforms you use for your portfolio, but there are some that do offer, and I can share this with you separately, that offer master tenant policies that you could open up on behalf of each tenant. It's not going to affect your master policy. It's not going to affect your package policy or any of your policies because it's under the named insured. It will affect your master tenant policy, but that's why you get it. They're cheap. They're usually somewhere about $100 to $150 a year for each tenant. It's going to give you the basic minimal coverages. But they're generally purchased for liability purposes, not so much for, hey, if the tenant is going to cause damage to the property.
That's what I know, but it's usually for liability mainly, not
correct. They're usually for liability. Yeah. And you should require all your tenants to get renter's insurance and list you as an additional insured. Because listen, it's not an issue until it's an issue. And when someone gets hurt on the property and the tenant does not have insurance, you are the only one with an insurance policy that's willing to pay out. They're going to come after.
We're going to have a conversation about that, Mendy, on a personal.
Absolutely.
Okay. Any more questions, guys? Daniel asked if you can briefly go again over umbrella policy because he missed the
absolutely
beginning.
One of my favorite things to do.
And we also like Daniel. So
yes, absolutely. One of my favorite things to do is to talk about this master policy. And I just want to, so there's umbrella and there's master, and I don't want to confuse the two. Umbrella insurance, and people more often than not, they say, oh, give me an umbrella that'll cover all my properties. Umbrella is excess liability. What does that mean? Your average general liability policy will cover 1 million per occurrence, 2 million per aggregate. Now, what happens if you need a lot more liability coverage? If you're worried, my property's worth $10 million, I need at least $10 million liability coverage. So any amount of coverage you want above that 1 million is going to be under umbrella coverage, which another term is excess liability. Now, to the master policy, that's where we're taking a portfolio and we're all bundling them together. I'm going to go through all of them point by point. We'll go through it again. And I know some of you might have heard it before. Maybe this time we'll add a little more information on each one. So the first thing is the leverage. Very often, someone comes to me, hey, I'm new to the business. I'm buying 3 properties. You know, later on, they buy one, they buy another one, they buy another one. I have a 60-cent property rate that we're paying, anywhere between 50 and 70 cents. After they have 5, 10, 20 properties, I say, hey, you know, listen, it's expensive. If we roll this into a master policy, I can go to the carrier and I can say, hey, I have 20 properties. We have leverage here. Can you offer us a 45-cent property rate or 40% property, 40-cent property rate? Or if you're in some states, a 10-cent property rate. So it gives us leverage to get a better price. most of us here feel like we're paying too much for insurance. Master policy, more often than not, can get a significant savings. The next thing is the no inspection. It's a big deal for most real estate investors. Every time you buy a property, you have the inspection comes back and says, I needed to fix the sidewalk, I needed to add a handrail. Well, guess what? You just bought the property, you plan on fixing it. It's going to take you 3 to 6 months. You're not interested in having all these inspection requirements completed in 30 days. So this master policy, this one, many of the carriers, they don't require inspections. They understand that you're not buying. They understand these are for real estate investors. You're buying the property, you're going to fix it up, and then you're going to rent it out long term. You're going to sell it. They understand that there's no inspection. The next thing is the locked-in rate. When you lock in, and at this point, if anybody wants to jump in on any of the specific topics I bring up on this, please jump in, ask a question. I'll be happy to elaborate.
Yes, I have a question.
Yes.
So when I said umbrella, I was meaning I was referring in a master policy,
Yes.
definitely. A question about the master policy. What if we hold several properties under different entities? Can we still have it under one policy?
Great question. As long as the different entities have common ownership, meaning if you have one property that's owned by one person, another property that's owned by someone else, no, you cannot.
Mm-hmm.
But if you have different LLCs that are common ownership, 50% common ownership between the owners, then the answer is yes. Because almost every one of the master policies I have, that we write, almost all of them, there will be many different LLCs because you don't want to put more than a few properties per LLC. You need to protect yourself. Honestly, every single property should have its own LLC. But yes, as long as there's common ownership, they can be under the same policy.
Okay, a question about the common ownership. Let's say I'm a managing member in one LLC and the other LLC, but then there's second and maybe third managing members on the different LLCs that are not on both of them.
Yes, it's fine. That's more often than not, that's what it is. More often than not,
Okay.
that's, we'll have property managers or real estate investors that they have 50 different, but as long as that person, let's just say you,
Mm-hmm.
as long as you have ownership in all of them, then yes, then it works.
Okay, great.
Great. I'm going to jump into the next thing. And again, any other questions, jump in. The next thing is the locked-in rate. And this is the big one. Every time you send over an address, we will say, hey, this has 1,000 square feet. 1,000 square feet at $125 a square foot means we need $125,000 of coverage. If you take $125,000 of coverage and we have a 30-cent rate, that's $375. The liability is costing us another $200. That's $575. Add in the surplus line, the state tax for that state, you're at about $600. When you buy that house, that's what the insurance is going to cost. If you have $250,000 of coverage, it's going to cost you $700 for the property coverage. It's a locked-in rate. At the beginning of the year, we had a locked-in rate. And then when the renewal comes, we're shopping it obviously for a better rate, but that rate is locked in for the whole year. Now it's only locked in for your state, meaning every state has a different rate. And if you own properties in different states, they cannot be under the same master policy. Every state will need its own master policy, but the locked-in rate is for the entire state. Every property you buy, that rate is locked in. The next thing, one policy for the entire process. When you buy the property, it's vacant, then you renovate it, then it's occupied. And then there's another thing. If you have 100 properties and every month, you have a tenant that's leaving, it might be vacant for 4 months, you might be looking to rent it out. During that period of time, you need to get a vacant policy because your current property, if it's vacant for over 60 days, there's a whole list of exclusions on there, whether it's water exclusions, there's a list of exclusions that will not allow it. However, the master policy does not have a vacancy exclusion. So that same policy, when it's vacant, you don't need to change the policy. If you're doing renovations in between tenants, one tenant leaves and the next tenant, you're gut renovating. Guess what? You don't need a separate policy. There's no renovations exclusion. Now, if you're doing extensive renovations, you want to get what's called a builder's risk policy, but this master policy will not exclude for renovation. Reporting form with binding authority. So that, again, it's about the process. You're buying properties. You don't want to have to spend all your time dealing with insurance. When it's done on a master policy with reporting form, that means you have the property address, you send it to us, we send you the binder and the invoice, because we have binding authority to add, and because we already negotiated the rate. So the carrier we negotiate the rate for the year. So any property, we don't need a request approval. We have approval on any property that's bought in that state. The flexible coverages, once we lock in and the carrier agrees to, hey, $110 a square foot or $125 a square foot, we can go as low as that coverage, or obviously, if needed, we will go higher. And then, yeah, it's designed for real estate investors and banks. It meets all the requirements that the bank asks for. Replacement costs, no co-insurance, the deductibles, the coverages, the liability. It meets everything that the bank wants. And the last thing is the claims process. It's, if you have a property and if you own 10 properties and you have one property that has a claim, and that renewal, that price might triple. If you have 10 and they're under a master policy, and you have one property that has a claim and the other 9 are still clean, it's helping us throughout the whole portfolio. You're not getting killed on that one property. And then if you have a claim, you don't have 10 different carriers and 10 different loss adjusters and claims adjusters you're dealing with. One loss adjuster, one claims adjuster that's dealing with all the claims. Yes. Anyone else has any questions regarding the master policy or any other topic if you want to bring up, and let's jump on it.
I have one question. Okay. Let's say we have the building in Texas. We have a policy, and I am a guest. I enter the building, something happened to me, the policy covers. Okay. I go to the parking lot, something happened to me, the policy covers. I get out from the building. Where does the policy covers? Is there a border between the policy that I have and then that I'm not responsible anymore? If I get, 10 meters away from the building, 2 meters away from the building, where is the border?
Yeah, good question. So there's obviously this is not a gray area. This is a black and white area of when you own a property. So it's not even just your house. That's what we're discussing about the sidewalk beforehand, that in New York, you have the property, you have the sidewalk in front, and you have the curb. The curb belongs to the city. I'm just giving an example. The sidewalk is your responsibility. You need to make sure, whether the snow needs to be shoveled away or whether there's a crack in the sidewalk or absolutely. So if you have an apartment complex, and there's a specific, when you purchase the property, you didn't just purchase the building, you purchased a lot size. You're responsible for anyone that gets hurt on that entire lot size. They step foot out of it, you're not responsible for it. And that's why. Sorry, what?
Lot line.
Yeah, exactly.
This is, by the way, one of the reasons I had this discussion with them before. This is why you want a survey. A lot of people don't buy with a survey. You want a survey. You want to know exactly where your liability ends.
Absolutely.
A lot of people don't buy properties with survey because not every title insurance requires survey. This is why you want to have a survey. You want to know what is yours. But to your question of fear, lot line.
Yes. And now when it comes to commercial buildings, I cannot emphasize enough, cameras. Every time we make a claim, the first thing I tell the insurer is save all footage. Then I reach out to sometimes we'll have what's called TPAs or, that guide them through the process if they're large claims. And the first thing is always you want to grab that footage. We just had one of our clients, they had one of their properties in the city, or no, this one's in the Bronx. Someone fell down the steps and lost it. Typical one. They grabbed the footage, they sent it to me. We see in the footage that, the woman is holding her kid on the steps, stands up, tries walking down the steps, tumbles down, ambulance, the whole thing. And there was a railing. Thankfully, there's a railing 1.5 feet away. If we didn't have that footage, there's no way you're winning a slip and fall in a Bronx area. It's tough to tell someone with a single family home to a rental property to pay for cameras, which again, we recommend it everywhere. But if you have a commercial building, whether it's an apartment complex or, a high rise, you want cameras. These days, it's a lot cheaper than it used to be, and it will save you significantly in the event of a lawsuit. So highly recommended. but yes, Ophir, to answer your question, and I think Tal explained that perfectly. But yeah, you have your lot line, and up until that line, you want to make sure. Yeah, if your fence, if you see that your fence for your apartment complex is you're responsible for 2 feet outside of it, maybe move out your fence or do what you have to do, because if someone gets hurt there, and people they play the game, they will get hurt there to try to to try to stir up a lawsuit. Yep.
I will tell you a story about that, Ophir. In Rochester, luckily we didn't get sued, but one of our tenants fell out of a window
Oh,
into the street, head first. And we didn't get sued because it went straight to a police investigation because he died. And they found out we had cameras, and the cameras just showing him falling. I actually have the footage head first to the curb. They ended up finding from across the street footage somebody throwing him through the window.
Yeah.
So it was a murder, and we didn't get sued because it was a murder. But if not, like, oh, I fell from the window, and they can see you.
Was he Russian?
What?
Yeah. He asked if they were Russian.
No.
I don't know the crowd here, so I'm gonna keep quiet on that question. But
Yeah.
yeah,
not Russian at all.
they disappeared the guy. Is
No,
yeah,
an argument,
good, yeah.
an argument between two tenants, and they just fought, and
That was one way to settle the argument.
One
Yeah.
or the other out of the window.
Yeah, listen, if you you asked about what things to worry about on inspections. You'll notice in New York, there's a lot of, they want those security bars on the windows, and they want, if anyone has an AC unit that's sticking out and needs to be secured. Why is that? People have AC units sticking out of the window, and it conveniently falls out and hits someone. So now you have a lot of these brick and brownstone programs that every single inspection, they want confirmation that all the AC units that are sticking out the windows are secured.
Yeah,
Yes.
it's always any more questions, and then I have the last question from Mendy.
Yes, I have a question. Say you have a residential unit or part, house or duplex or whatever, and is not insured. And one day you decide to insure it because, let's say, you want to refinance. Is it a problem to insure a property that was not insured before?
Yep. Okay, so that's the big unfortunately that's the big when it comes to insurance, it's all when there's no prior insurance, I wouldn't say there's necessarily a problem. Now there's two things. When obviously for a new purchase, they're not asking any history, but when you have an existing property, so to back up, if there is a lender involved and you did not buy insurance, they will most likely place what's called forced place coverage. The lender wants to protect themselves. Part of their agreement with you to give you the money is if you don't have insurance in place, they will force place coverage, and they will send you a letter saying, hey, we force place coverage to protect ourselves. We recommend you reach out to an insurance broker. They'll give you something significantly more competitive. But if you don't, you're required to pay this amount of insurance. Now, to your question, if you don't have insurance until now, it does limit opportunities. There are a lot of carriers that, the number one thing they want to see is, what's your history? How long do you have insurance for? Do you have no claims? We're happy to write it. If there's a lapse, usually we'll have to give an explanation. But unfortunately, it's very common for someone to reach out to me and say, hey, I didn't get insurance. I own it. I don't have a lender. I have no interest in paying that amount. They're technically self-insuring is the way they refer to that. We'll take on the risk ourselves. We're just not willing to get insurance. Can we get, obviously, yes. The answer is yes. We can always get insurance. It just might cost a little more. You might not have every market available. But something like a master policy, that would not affect that, because they will, once we locked in a rate at the beginning of the year, you can add on to at any point, regardless if there was prior insurance or not. There's no, they're not asking for what's called loss runs. Every time you're trying to get a policy, you're shopping something out, the carriers will ask you for loss runs. That's the history, primarily in commercial, not so much on single units, but they want to see the past 3 to 5 years. Have there been any claims? When it's large risks, even if it's a new purchase, they'll want the seller's loss runs. We want to see the seller. Have they made any claims in the past 3 to 5 years before they're willing to take on this risk? Yes, to answer your question, yes, you can get insurance. we might not have the same options, but that doesn't affect the master policy that we were discussing before. They don't ask questions about prior insurance.
The amount of time, the period of time that you didn't have insurance matters. It can be years or months, or
If you're
doesn't
referring
matter.
specifically to the master policy, they don't ask for loss runs. So any carrier that's not asking for loss runs, it doesn't matter. It can be 1 year, 5 years, 10 years. They're not asking for loss runs. You don't need to provide it. Listen, I'm working on behalf of the clients, obviously. So you don't want to bend or break anything, but we're not voluntarily offering information that they're not asking for, So if they ask us, hey, is there a lapse in coverage? We're never going to say no if there is a yes, because that can come back to bite us. But the master policy is not asking if there was prior insurance. And just one thing to know, there are many carriers, I shouldn't say many, but there's quite a few carriers that offer this master policy product. Some of them have some pros and cons. What I listed here are pretty much all the things I'm looking for with the carriers that I write with, but some of them will be a little, they might, there are some that might be a little more flexible and some might be a little less flexible. But to answer your question, yes, you can get insurance regardless of the history. It just may be difficult. There is one final note to this, whether it's residential, commercial, there's always someone willing to offer a quote. You may need to go non-admitted. We may need to go with a wholesaler. We may need, there's always someone. There are excess lines markets that will write anything at a price. We can get a quote for $10,000 with an admitted, and then there was a lapse and no one wants to touch it. Yeah, someone will write it for $40,000. So at a price. But if you're talking about single units, generally not a major issue, and there are enough markets that are willing to write it competitively.
Any more questions? Okay, Mendy.
Yes.
Last task. You need to give us an insurance joke.
I have another
joke.
question.
Yeah, Daniel.
First go Daniel, and then I'll come
You have
up
a
with
second
joke.
to think about it.
Mendy,
I'll have
how
a second
is your...
along with ChatGPT. Let me see if we can cook something up together. I'm kidding. I shall not be doing that. I'm kidding. Go ahead, Daniel.
How are your fees calculated? Is it like, do we pay you directly as the client, or is it coming from the insurance company? And how does that work? How's your compensation?
Yeah, so I'm a broker, and you don't pay us. The insurance carrier pays us a commission directly. These are all state regulated. Like, there's no I personally don't charge any broker fees. So if you're asking, there's no fees that you pay towards us. You pay the insurance premium. The carrier will pay us a commission of that. And I know some brokers may, but I don't charge any broker fees, so no fees to that end. Tal, an insurance. I'm sorry. Go ahead, Daniel.
One second. Yes, Daniel.
Question.
Yeah, sorry. Go ahead.
I know many brokers work like that, but I was wondering, isn't it kind of a conflict of interest, since we are not the one, like the client is not the one paying you, the insurance company is the one paying you.
Great question.
Aren't they actually your client?
So in fact, it's the opposite. Because I'm an insurance broker, now there's two things. There's a broker and an agent. An agent will work for a specific carrier. They write with one carrier. Broker writes with everyone. For me, it makes no difference to me what carrier you go with. I just don't want to lose your business. And I know that at every renewal, I have that same mindset. There are 10 other brokers fighting for this. And if another broker comes with a quote that I didn't have, I could lose that business. So I don't, I have to shop it. To me, it makes no difference what carrier you're going with. I just have to get you the best possible quote, so I don't lose your business, because there are other brokers that are always fighting for new business. So but if you're referring to, just be more specific. Did I answer the question?
Yes. Yeah.
Yeah. Okay. So yeah, this is at the end of the day, it doesn't matter to me what carrier you go with.
Thanks.
Tal,
yes.
I'm gonna try. Okay, so briefly thinking about it, a good joke on insurance. Insurance is no joke. It's no joking matter, and I would highly recommend that no one ever take it in a joke. So I'm not gonna make any jokes about insurance, because there's nothing more serious. No,
I'll make it.
no,
I'll make it.
Go ahead.
I think I wrote it down on the WhatsApp there once. Two guys, I'm not gonna say which religion, meet up on the beach in Miami. And one tell the other, "Oh, what are you doing here?" Say, "Oh, I retired." Say, yeah, I used to have real estate. There was a fire. The insurance paid me the insurance money, and I decided to retire. Oh, amazing! It's like, what are you doing? It's like, oh, I used to own a business in Texas, and there was a hurricane, and it wiped the building and my business, and I got the insurance, and I retired as well. And he said, "Oh, this is amazing, but how do you start a hurricane?"
Yeah. Yes. We're not going to discuss what religion they may have been affiliated with or anything of the likes. But
Exactly.
yes, unfortunately, that's why insurance is expensive.
Yeah.
That's why insurance is expensive.
Guys, Mendy, first of all, thank you very much. We appreciate your time.
Thank
Taking the time
you.
explaining.
Thank you.
I'm going to send everybody a recording of this conversation with you and your contact information, obviously. And anybody have any question can approach Mendy directly, and I'm sure Mendy going to be happy to help. Next week, we're going to have the same time cost segregation, which is also a great way to save some money. So you guys going to be invited. I'm going to send everybody an invitation. Cost segregation. Guys, have a great week. Thank you very much. I'm very happy to go back to doing Zoom meetings on Mondays. I missed it a little bit, I'll be honest with you, the last couple of years. But we're trying now to get back into rhythm. So I'll see you again next week.
Tal, thank you very much. And if anyone wants to reach out to me with any additional questions or you want to discuss anything insurance related or anything related, please reach out to me. Really a pleasure, and God bless. Stay safe out there. I belong to live out. We all belong to live out there, and I someday look forward to. And my mom, she lives in Nachlaot. She made Aliyah maybe 10 years
nice.
ago. So yeah. So
Very cool.
sending love. Stay safe. Peace. And thank you very much for your time.
Thank you very much.
תודה רבה.
Bye bye.
תודה רבה.
Thank you, Mendy.